This is Horizon's Middle East and Africa, our top stories this morning. Markets cheer. The Fed cuts rates by a quarter point as Jerome Powell touts the U.S. economy's resilience. But President Trump thinks the cut is not enough. The dollar suffers its worst day in nearly 3 months as the Fed chair highlights labor market risks while downplaying inflation concerns. And escalating tensions, U.S. forces intercept and seize a sanctioned oil tanker off the coast of Venezuela, a move that could make it much harder for the oil-rich nation to export its crude. It's just gone past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi. And as markets were anticipating, we did get that quarter-point cut from the Federal Reserve. But it's really some of the commentary that we got from Fed Chair Powell that markets are trying to dissect, and especially, of course, some of the dot plot, the details in the dot plot. So let's just take a look at where markets are trading right now. If we take a look at U.S. equity futures, continuing to slide, which is what we saw in extended trading after we got some disappointing results from Oracle. As you can see there, S&P futures down just about 0.8% there. Part of the concern is really about what this means for the broader AI trade, and S&P futures, or excuse me, Oracle actually bringing down SoftBank, and as a result, what we're seeing some downside in Asia as well. But still, this really reverses what we saw in the previous session, which were gains for many U.S. equity indices after that Federal Reserve decision. And we actually saw the S&P closing just short of an all-time high on Wednesday. So definitely pulling back from some of those gains. The U.S. 10-year yield right now, we're seeing yields pulling back, edging lower ever so slightly, a reversal from some of the run-up in the yields that we did see earlier in the week, with the U.S. 10-year yield at about 4.12% there. Plenty to continue watching, especially as we see other central bank activity. Risk aversion also hitting Bitcoin, as you can see there, down more than 2.2%, and really trading below, well, just above that $90,000 print, actually. And a bit of this risk aversion is also bringing down digital assets more broadly after that quarter-point cut from the Fed. And Brent crude marginally down right now, just about 0.1%, though we are watching how geopolitical developments in Venezuela and also between the Ukraine and Russia is affecting the oil picture. We are also waiting for some key reports, including from the IEA, potentially giving some insight into what the supply-demand picture looks like for oil in 2026. But Brent right now trading at about $62.14 a barrel there. And let's just bring you our terminal chart this morning. As expected, as I mentioned at the top of the show, the Fed did deliver a third consecutive interest rate reduction, about a quarter point. But really a lot of focus is being put on some of the dissents that we did see. And as this chart is showing, it's the largest internal divisions that we are seeing since 2019, with three dissents, to what ultimately we did see was that quarter point cut. We did hear Fed Chair Powell trying to at least gloss over some of these dissents, saying that there is a case made for both easing as well as holding, but still many people wondering what this then means for the Federal Reserve, especially as we head into 2026 and Chair Powell's term ends at the beginning of the year in May. Let's, though, zoom in on how markets in Asia are faring. Min Lo is standing by in our Hong Kong studio with more. Min, what are you watching this morning?
Yeah, well, we started off the day really cheering the Fed cut from the U.S., right? And the Asia-Pacific benchmark was in the green earlier this morning, but now we are flipping to negative territory. I think it's down about close to 0.5% here. And you can see among the regional benchmarks, the Hang Seng is the only one that is holding on to gains now. But these tech-heavy indexes, the Nikkei, Kospi, TAIEX, all in the red this morning. And it's really the Oracle story that is taking over the narrative now. That earnings that we got last night, pretty disappointing, especially when it comes to earnings, and the ROI really not meeting expectations there. And you add to that, the company is expanding its capex spending far higher than had been anticipated as well. So there is this fear of that AI bubble that is coming back to markets. You can see here how Asia is impacted. SoftBank, of course, the most impacted here, down about 7% because of its close ties to OpenAI and to Oracle and these other names seems TSMC, Hon Hai, SK Hynix are also among some of the suppliers for Oracle as well.
Thanks so much, Min Min Lo in Hong Kong for us. Min Min, we'll check back in with you in just a bit. Now, Fed officials have delivered a third consecutive interest rate reduction and maintained their outlook for just one cut in 2026.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. Available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months. So I don't think that a rate hike is anybody's base case at this point.
Joining us now from Dubai is Aarthi Chandrasekaran, head of asset management at Shuaa Capital. Aarthi, great to have you on today. So let's just talk about Shua's expectations leading into the meeting. You had expected 2 rate cuts into 2026. Give us your outlook now that we have heard from the committee and from Fed Chair Powell.
The messaging and the tone of the Fed was less hawkish than what we had expected and the market has expected. But then if you look at the dot plot guidance, the forward-looking guidance, it was less dovish. I think the market was looking at 2. We were looking at 2 as well for next year. The Fed basically came and said just 1. The reason why they were less hawkish in the tone was obviously, Jennifer, was because of the labor market trends, which is softening compared to the same time last year. But there's only so much the Fed can do because they don't have the data to back up. They don't know how materially has it worsened, right? So they're just walking blind. So obviously, till we get the labor market data, they can't really commit on a couple of more rate cuts for next year. So they're just trying to play it safe here. Just have 1 rate cut for next year, but as and when we get the labor market data, and if it actually materially worsens, then they might change their views in the first quarter of next year.
How much do you read into the dissents, Aarthi? Especially, we were showing a chart that showed about 2019, or it's been since 2019 since we saw 3 dissents. How are you reading into this?
I mean, market expected a divided Fed, Jennifer. I'm not sure I would read too much into it. This was anticipated. What is big for the market is going into the next year, the outcome of Lisa Cook and what the Supreme Court decision goes around that particular outcome. And if that goes, if it goes not so in favor of the current Fed governor, and then you have the leadership transition of the current chair, Powell, then that's like 2 votes down, and that could actually increase the influence of the dovish members in the team. And then you might have some wide dispersions in terms of the policy decisions.
Let's square that with what we're seeing globally, Aarthi, and especially the BOJ, because we're watching closely what we do get from the BOJ. We did see Treasury bills, an auction that actually went better than many expected. How do you square what we're seeing from the Fed with the BOJ and other central banks?
I think what is happening pretty much in the long end, and this is something which we see as a main theme for 2026, is the rate market volatility. Especially on the long ends, we expect there's going to be like a steepening curve. I mean, look at it, like Japan's ongoing normalization in terms of long-term yields is actually paying way to it. And then you have pretty much of global indebtedness, which has gone leaps and bounds since COVID period, and that is pushing up pretty much all the long-term yields from Japan to Germany, right? And that's something which I guess is going to be a global phenomena next year. Rate market is going to be volatile, which is why we keep saying that play the boring game as far as the credits are concerned, clip on the coupon, stay the course. I know it's a very boring message, but it's still, I mean, take a neutral duration risk, beat in the belly of the curve, but sometimes boring is beautiful.
Have you reevaluated then your portfolio in the past 2 days, or are you sort of staying the course, being boring, as you were just mentioning there?
As far as the fixed income and credit markets are concerned, we are taking more positions on the investment grade names. I know the credit spreads are extremely tight, but that being said, what is also surprising is despite all the volatility that we have seen in the equity markets and the Bitcoin, credit spreads have held up phenomenally well. I mean, that's like amazing, right? So I'm not sure if valuation should basically deter you from getting into credits. You still get a very good and attractive yield for credits in 2026, and that should keep your pace, clip on the coupons, and play a waiting game until you get more clarity from the new Fed chair.
Okay, so that's bonds, that's credit. What if we look at equities and in terms of balancing your portfolio regionally with what we're seeing potentially in DMs and in the U.S.?
We are still constructive on U.S. markets, Jennifer. But that being said, we are extremely selective within the mega tech names. We have kind of reduced our positions in mega tech, and we are sitting underweight at the moment. We love the AI trade, nothing there. We still think AI trade will rule the world in 2026. That being said, it's a bit too early in terms of who the leaders would be, where the revenue model, how the revenue model will look like, what kind of technology are we talking about, who's going to be the first to monetize, who would monetize the most and the first, and then who would be the leaders. And there could be some winners and losers as we think of this particular trade, and hence we have repositioned our portfolio for that, and hence we are underweight on Max 7. That being said, we have also diversified beyond Max 7, more into healthcare, consumer staples, software names, etc.
So you don't have any doubt then, we were mentioning Oracle and SoftBank being pulled down a bit, dragging other equity indices down. You're not concerned then about the AI trade at all at this point?
No, this kind of volatility you're going to see more as we get into 2026, right? I mean, valuations are high, and market expectation is that every single announcement from the AI companies should be up and very solid. So any kind of a disappointment from any one of the players, doesn't have to be everyone, but any one of the players is going to pull the whole market down. That's because the sentiments are extremely positive at the moment. But that's the price you pay when your markets have gone up for three straight years.
So hold the line is what you're saying. Aarthi Chandrasekaran, head of asset management at Shuaa Capital, joining us there in Dubai. Aarthi, always great to speak with you. Thanks so much. Now, for a look at some of the other stories we're following today. President Trump has signaled he would oppose a Warner Brothers deal that doesn't include new ownership of CNN, creating a potential wrinkle for the bid from Netflix. The streaming giant's plan includes a spin-off of Warner's cable channels. Paramount, for its part, is trying to buy the company outright for $30 a share.
I think any deal should be guaranteed and certain that CNN is part of it, or sold separately. But I don't think the people that are running that company right now and running CNN, which is a very dishonest group of people, I don't think that should be allowed to continue.
A federal judge in New York has ordered the release of grand jury materials from the sex trafficking investigation of financier Jeffrey Epstein at the request of the U.S. government. The ruling follows similar decisions by judges in Florida and New York. Last month, President Trump signed an act requiring the Justice Department to disclose all related unclassified documents. Coming up next, U.S. forces intercepted and seized a sanctioned oil tanker off the coast of Venezuela. We look at what the risk is next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. U.S. forces have intercepted and seized a sanctioned oil tanker off the coast of Venezuela. The move marks a serious escalation of tensions between the two countries and could make it much harder for Venezuela to export its crude, as other shippers are now likely to be more reluctant to load its cargoes. Let's bring in Jill Desis, Bloomberg senior desk editor, to walk us through this. Jill, give us a sense of how this all unfolded and what Venezuela's reaction's been.
Yes, Jen, as you mentioned, this is a very serious escalation here. What we know is that this was a vessel, very massive, capable of carrying 2 million barrels of oil that the U.S. intercepted. They said it was coming from Venezuela. They're saying again that essentially they've seized the ship here. What we've heard from Venezuela so far is akin to that kind of very serious reaction. Them saying this is a blatant theft, act of piracy. The Venezuelan government is also saying that it would defend its sovereignty and national resources with absolute determination. This is, again, when you're looking at these tensions between the United States and Venezuela, I mean, what we've seen from the Maduro's government is that they've characterized these actions by the United States as a grab for Venezuela's oil reserves. As we were discussing, I mean, this does have some fairly serious implications potentially for Venezuela's oil exports. And yes, again, we're looking at something that's potentially very serious indeed. We'll have to see how else Venezuela responds. But again, that initial response, obviously, in calling this an act of theft, I think gives you some sense of the gravity of the situation here.
Certainly, and the tensions between these two leaders. But Joe, how could this impact Venezuela's oil exports, as you were just pointing out there?
Yes, well, Jen, I think as we've been discussing here, this could make it a lot more difficult for Venezuela to actually export crude oil. If your shippers looking at what the situation is here, the amount of attention that the United States in particular has really paid, to these waters to Venezuela, I'm not sure that you're necessarily going to be particularly interested, or you might be reluctant in sort of loading your cargoes to sort of deal with this. Again, really hard to understate the size of this vessel, that the United States has seen here. So you're looking at some pretty, serious implications there. Again, I think we'll have to see how this continues to unfold, whether this incident continues to escalate. We've already seen a little bit of a reaction there with Brent futures earlier moving a bit higher off of this news. Whether that actually continues to, sort of exacerbate the situation, we'll have to see. But again, it does, I think, spell some pretty serious implications there for Venezuela's ability to sort of export this oil.
Yeah, and we'll watch that price action for crude definitely very closely. Jill Deesis, Bloomberg Senior Desk Editor. Jill, thanks so much for joining us. Coming up, The Information reporting that DeepSeek used banned NVIDIA chips to develop upcoming AI models. More on NVIDIA's response next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Ukraine has sent a revised peace plan to Washington as President Donald Trump held a call with European leaders about ending the war. Trump told reporters that he thinks it's time to get the war settled, but several sticking points continue to stymie a deal. European leaders say this is a critical moment for Ukraine, and intensive work on the peace plan is continuing. And Venezuelan dissident Maria Corina Machado appeared in Oslo hours after her daughter accepted the Nobel Peace Prize on her behalf. The institute said that Machado had undergone, quote, a journey in a situation of extreme danger to reach the Norwegian capital from her place of hiding. Machado was awarded the Peace Prize for her tireless work promoting democratic rights and her struggle to achieve a just and peaceful transition from dictatorship to democracy. Now, let's turn to tech. Oracle shares tumbled in late trade after earnings that suggest its boost in capital outlays may be taking longer to translate into revenue than investors hoped. Let's get more from our tech correspondent, Annabelle Drulers in Hong Kong. So, Annabelle, quite a hit for Oracle. Dig into some of the details that we did get from the company and why the market's reacting this way.
Yeah, well, the market's reacting this way mainly coming down to two things. There's firstly the CapEx and then there's the ROI. But talking about the CapEx first, essentially what the company reported was much more spending than actually had been anticipated. So in the fiscal second quarter, there was $12 billion that went into CapEx. You compare that to the fiscal first quarter, so the 3 months prior, and it was $8.5 billion. So it was a big run up. And then in addition to that, you had Wall Street analysts that were saying that they were looking at around 8.25 instead. So they actually thought it would trend down, but it went in the other direction. So that's one side, the spending side. But then in terms of what they're getting back, we did see cloud revenue increasing, but still it came in at around or just near $8 billion. You saw the revenue from the business infrastructure or the infrastructure side as well, business, and that came in around $4 billion. And that both of those undershooting Wall Street analysts' estimates slightly as well. So an undershoot on that side, way more than expected on the other side. And combined, you saw really that huge sell-off on NVIDIA stock, or rather in Oracle shares in late trade. But when you take a look at how that's affecting trading sentiment in Asia today, I mean, it's having a very big bearing because you're seeing IT stocks that are dragging down the broader index on what otherwise probably would have been quite a positive day in light of the Fed decision.
Yeah, absolutely. Kind of overshadowing some of the gains that we did see. Annabelle, let's talk about this reporting that we got from the information about China's DeepSeek potentially using banned NVIDIA chips to develop an upcoming AI model. It's hard to believe we were talking about DeepSeek in depth in January and it's December now, but what do we know at this point?
Yeah, well, what we know is that back in January or early this year when DeepSeek did release that model, that was the R1. And then since then, we've had these sort of incremental updates, but we're still awaiting R2. And what we're understanding, or what the information has reported, is that DeepSeek's been developing this next major model release using Blackwell chips. Now, they're talking about, or they're looking at sources that are close to the matter. They're saying they spoke to 6, in fact, to bring together this reporting. But what they're speaking about, the information, is quite a complex web, where essentially NVIDIA chips were being sent to data centers in countries that could buy them. And then the servers, those eventual servers, were being dismantled, and some of the equipment with those chips in them was being imported into China. And so that's, they're saying, is the loop essentially in how these chips were making their way into the mainland market. If this is accurate, I think it tells us a few things. Firstly, it tells us how difficult it is for the US to enforce export controls. I think for DeepSeek as well, it really shows their reliance on US technology because, as I said, we're still awaiting R2. And it is a model, or their approach to building models so far has been very much focused on a method called sparse attention. And Blackwell chips particularly well suited to models that use sparse attention methods because they have specialized hardware in them, the Blackwell chips, that are designed to accelerate sparse computing. So that's the reliance for DeepSeek. For NVIDIA itself, it's rejected not the claims directly or the information directly, but they did put out a statement saying that they rejected the claims of phantom data centers, and they said they've seen nothing that's really substantive to tell them that there are essentially these phantom data centers out there. And so that was the response from NVIDIA. But again, it's an interesting story, and that reporting coming from the information.
Yeah, thanks so much, Annabelle Drillers, for digging into that, our tech correspondent there. Annabelle, great to get you on the show as always. Now, coming up, we discuss the outlook for EM debt with Omotunde Lawal from Barings. That's next. This is Bloomberg. This is Horizon's Middle East and Africa. Our top stories this morning. Markets cheer. The Fed cuts rates by a quarter point as Jerome Powell touts the U.S. economy's resilience. But President Trump thinks the cut is not enough. The dollar, though, suffers its worst day in nearly 3 months as the Fed chair highlights labor market risks while downplaying inflation concerns. And escalating tensions, U.S. forces intercept and seize a sanctioned oil tanker off the coast of Venezuela, a move that could make it much harder for the oil-rich nation to export its crude. It's just gone past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersetchi, and we did get that quarter point cut from the Fed on Wednesday as the markets were anticipating. Perhaps what they weren't anticipating, though, are some of those disappointing results that we did get from Oracle and after-hours trading, which sort of soured the mood that we saw, a bit of the exuberance that we saw for global equities and especially U.S. equities. As you can see there, S&P futures down just over 8%. 0.8% there. Potentially some concern about the AI trade. Oracle also dragging down slightly. SoftBank and some of the Asian equities as a result. So paying close attention to how that transpires. The U.S. 10-year yield pulling back, edging lower right now after we did see a run up in yields over the past few days. That, of course, coming after that Fed decision. The U.S. 10-year benchmark at about 4.1254 there. Let's take a look at Bitcoin, though. So some of the risk aversion clearly playing into the downside that Bitcoin is seeing right now, down over 0.2% there, continuing its march lower, although it is above $90,000 there, but ever so slightly. And as a result, we're seeing Bitcoin and also other digital assets being dragged down after that quarter point cut from the Fed. And we're tracking how geopolitical developments progress, especially as it pertains to Venezuela, as we mentioned at the top of the show, and also the situation between Ukraine and Russia as far as how that feeds into the energy picture. Brent crude down right now just about 0.2%. And we should also note we're waiting closely for some reports from the IEA and also OPEC to get some insight into what the supply-demand picture looks like for 2026. But Brent crude down right now, trading at about $62 a barrel there. Let's just take a look at our terminal chart for this morning. And as we were mentioning, of course, the Fed did deliver that third consecutive cut. But many people wondering what this looks like in 2026, what the Fed looks like in 2026, especially if you take a look at the descents that we saw. We did see 3 descents, and it's looking like this is a bit of internal divisions are perhaps the highest that we've seen in quite a few years since 2019. That even despite what we heard from Fed Chair Jerome Powell, which he said, there's a case for both easing as well as holding. So perhaps don't read too much into the descents. But still, when we get a new Fed chair in May, what does that mean for the new Fed chair and also the Federal Reserve for the rest of the year? Let's check in, though, on how markets in Asia are faring. Min Min Lo is standing by in Hong Kong for us. Min Min, I see you have the yen up there. Dig into that for us.
Yeah, it's interesting to see the market moves today because it's been pretty volatile. You can see here the yen strengthening about 0.25% earlier this morning. It's one of the clearest beneficiary of the weaker dollar following that rate cut. But now it is sliding again and trading almost flat at the moment. Now we have the Fed rate cut behind us. We are looking ahead to the rate hike or potential rate hike, I should say, next week. But traders pretty much pricing in that hike now. And we have an ex-BOJ official as well saying that he sees as many as 4 rate hikes by 2027. But interestingly, not enough to move the yen here, although it's still pushing below the 156 level. We are watching what's happening in the fixed income space as well, because the Ministry of Finance auctioned the 20-year bonds today, the last ultra-long bond auction before the BOJ rate decision. We are seeing yields across the curve here coming lower. It is really supported by firmer treasuries as well. But the auction really saw solid demand, the strongest since 2020. We continue to see this curve flattening theme taking hold here as we look ahead to the BOJ decision. And I think the bond traders today will be able to enjoy that rolling down of the yield curve, given the strong demand at the longer end, and that demand also boosted by bets that long bond issuance next year could be trimmed as part of the new fiscal year budget as well.
Interesting, especially considering that JGB auction. Min Min Lo in Hong Kong for us. Min Min, thanks so much for that report. Now, Egyptian inflation slowed slightly, even after a cut in fuel subsidies, potentially giving authorities more scope to reduce interest rates later this month. Consumer prices in urban areas increased an annual 12.3% in November, compared with 12.5% the previous month. Joining us now is Ziad Daoud, Chief Emerging Markets Economist for Bloomberg Economics. Ziad, what is the outlook for Egypt's inflation at this point for 2026?
Well, Egypt's inflation tends to move in 3 stages around crises. And let's remember that Egypt had a crisis in 2024. The first stage is during the crisis itself, inflation shoots up above 30% as the currency collapses and there's a big devaluation and prices rise. Luckily for Egypt, that stage has passed. Then there's a second stage in which, after some currency stabilization, as the effective devaluation drops out of annual inflation calculations, you get inflation dropping from above 30% to the 10 to 15% range. And that's the stage that Egypt is in currently, with inflation is in the 12.5% range. Then there's the third stage. If Egypt's policy remains tight, if the central bank keeps interest rates high, if the global environment remains favorable to Egypt in the sense that oil prices remain low or declining, food prices remain stable, global interest rates, importantly for Egypt, remain low or falling, then the inflation can move from the second stage, which is between 10 to 15% range, to the high single digits range. And that's basically where the Central Bank of Egypt hopes to target in late 2026, with inflation in the 5 to 9% range. So currently Egypt, in the second stage where inflation is the 10 to 15% range, but hoping to move to single digits late next year.
And there's been quite a bit of volatility, Ziad, since we did see Egypt actually getting that IMF program last year in 2024. There is a mission, though, currently in Cairo. What is expected from this review, especially considering the outlook that you were just mentioning there for the economy?
So for the IMF, it's combined reviews for Egypt, and at stake is about $2.5 billion of additional disbursement from the IMF to Egypt. I think there is more of a chance of the IMF, basically Egypt passing the reviews and the IMF disbursing the money because of two recent developments. The first development is in October, when Egypt lifted energy prices domestically, lowered the subsidies, and that's despite an environment in which global energy prices were falling. And that is part of the IMF conditions for Egypt, or the Egyptian commitments to the IMF. The second development is the money that came from Qatar to Egypt, $3.5 billion in exchange for land and land development. And yes, strictly speaking, that's not a divestment of state assets in Egypt, but it remains a significant amount of foreign direct investments going into the country. So because of the lifting of subsidies and raising fuel prices domestically, because of the Qatari money, there's more of a chance that Egypt would pass the IMF reviews and get the IMF money this time around.
We'll wait to see how that mission, what they telegraph from that mission. Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics there in Dubai. Ziad, always great to speak with you. Thanks so much. Let's stick with emerging markets and talk about emerging market assets, because they're trading lower after an initial pop higher following the Fed's 25 basis point rate cut. Both stocks and currencies are tracking global assets lower as disappointing results from Oracle sour market sentiment. My next guest expects the dollar to trade softer in 2026, which should reduce external debt burdens and support EM carry trades. Joining us now is Omotunde Lawal, head of EMEA Corporate Credit and Emerging Markets Corporate Debt at Barings. Omotunde, great to have you on the show. Let's just start here from some of the reaction that we're getting, at least in EM credit markets, to the Fed decision. Is your expectation that this will hold, or what's your outlook for really where the EM credit space goes from here?
Thank you, Jennifer, and good morning, everyone. Generically, yesterday's 25 bips rate cut, very well telegraphed, I think very well expected by the market. I think for 2026, our direction of travel will really depend on data, as Chairman Powell said yesterday. It's going to really be about that sort of tension between softer labor market and whether or not the U.S. growth reignites in 2026, which means, the Fed's decision around rate cuts becomes harder. And depending on the path that we take, that also sort of impacts how we see credit for 2026. But generically, my view is we will see a weaker dollar, and a weaker dollar is generally good for EM credit. It reduces external debt burden. It's good for the domestic economy within a lot of these countries, because the corporates there are able to have a much softer environment to operate in, where their sort of debt capital structures are easier for them to service the debt. And when I think about 2026 as well, where, the push-pull factors with the US and the AI capex, that is also something that we don't see a headwind for emerging markets credit with as well. So structurally, we see a lot of investors are underweight their allocation to EM. And I think with the amount of supply that is expected in the US space around the AI tech capex spend, I think that also gives the potential for investors to be looking elsewhere, which is also supportive for EM credit for next year.
What do you see as the catalyst then for some of that rebalancing for EM credit as compared to developed markets in the U.S.? What do you need to see next?
I think generically a Goldilocks environment is good, where you're not seeing huge amounts of volatility in the US. So long as we're not projecting or expecting a recession or a huge slowdown in the US, I think that is supportive for EM credit. I think that's generically the sort of environment we've been in for the best part of the second half of 2025 after the whole Liberation Day excitement. So long as we're expecting a Goldilocks environment where growth in the US is actually pretty decent, growth around the world is okay. Growth in the emerging markets are expected to be very solid for 2026. So that is good for the expected higher structural allocation to EM. A lot of EM central banks already have cut rates. Inflation is largely under control, so domestic growth should be supportive. A weaker dollar is supportive. Higher commodity prices are supportive for emerging markets. I think the general forecast is we're expecting strong copper, all the transition metals, iron ore, aluminium. So that is supportive for EM. So strong commodity, weaker dollar, sort of Goldilocks environment in the US. I think the only thing that, we need to watch out for is that rates volatility, where the Fed's job is harder, with the dual mandate. Are they looking to cut rates, or are they going to have to hike rates if we start to see a resurgence of growth in 2026? Remember, 2026 is midterm elections in the US. There's expectation of maybe some tax cuts or some fiscal boost coming through. The uncertainty that we had from the tariffs in 2025 should be largely dissipated for 2026. So there are a lot of things in the pot that suggest that we should have a rather benign to strongish 2026 in the US, and that should be supportive for emerging markets credit.
We'll wait to see how that actually pans out. We were just looking at the MSCI Emerging Market Index. Of course, it's down as we're seeing major equities globally down. When we take a look at some of the corporates and the growth sectors that you believe have more tailwinds heading into 2026, what's your focus there?
Within emerging markets for 2026, I definitely like commodity sectors I spoke about, but I like the metals, I like copper, I like iron ore for 2026. Yes, oil prices are expected to be lower, but that isn't necessarily a huge disaster. From a corporate's perspective, a lot of the corporates are actually low oil producing or low break-even producing oil producers. And so that isn't necessarily a disaster. I think a lot of the break-even levels for a lot of the EM credits that we look at is anywhere from $45 a barrel to $55 a barrel. So that's not a disaster. I really like the sort of some of the domestic sectors like TMT within emerging markets. I like that very much. We like the banks. The banks are very well capitalized. They've been in a very good spot as well. We like the enablers, the AI enablers within Asia. You think about the Alibabas, the Tencents, the likes of those. So there's some pretty good sectors, I think, next year as well, because we potentially have the weaker dollar. You have EM central banks with more room to cut. There's growth baked into a lot of the EMs as well. The consumer sector should also be largely resilient next year. So we like fins, we like consumer, we like some of the digital sectors, and we like commodities-related sectors.
We'll leave it there with you. Omotunde Lawal, fascinating insights, head of EMEA corporate credit and emerging markets corporate debt at Barings, joining us there in London. Omotunde, great to get you on the show this morning. Now coming up, U.S. envoy Tom Barrack says Turkey must abandon Russia's air defense system to get F-35 jets. We'll bring you that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Washington is signaling that Turkey must no longer possess the Russian S-400 air defense system if it wants to rejoin the F-35 fighter jet program. U.S. envoy Tom Barrack said America hopes that talks will yield a breakthrough that meets security requirements of both countries. For more, we're now joined by Bloomberg's Patrick Sykes. Patrick, talk to us about how significant this latest message from Washington is for Turkey.
Morning, yes. I think it signals progress, but not a breakthrough yet. What we're seeing is Barak break down the problem into two components. First, Turkey's operation of these missile systems, on which Turkey seems to be doing fine, because beyond a test, they're not known to be actively operated. And secondly, possession. That's the much stickier part, the simple fact that this air defense system is still on Turkish soil, and that is in itself a problem for the US. I think insofar as he's also giving a more concrete timeline, expecting some kind of deal resolution in the next few months, that's also a positive signal, especially when this is an issue that's been a thorn in the side of US-Turkey ties for the best part of a decade now. And then the mood music also, between the capitals has been much better lately as well. We've had Erdogan in Washington in the White House meeting Trump. We've had Turkey buying a lot of US gas recently. So there is a kind of atmosphere that's more conducive to a deal and a bit more specificity on the timeline about how it might come about.
Sure. It does seem like that is where things are headed. But Patrick, is there any indication Turkey really is ready to give up these Russian missile systems?
Yeah, from the Turkey side, the foreign minister a few days ago said he was hopeful of a resolution to the sanctions which came about because of this missile system, but he didn't mention the missile system itself. And there's the rub, really. Turkey really doesn't want to be seen to be bowing to US pressure on this, on an issue as strategic as national defense. The one way out of it that Turkey might find is it's been working on its own locally developed air defense system called Steel Dome. If Turkey can advance that to a stage where it can say, look, we no longer need this foreign Russian system because, look, we've been able with our domestic expertise and engineering to develop our own, that could be a way out because, it would allow Erdogan here in Turkey to take the political win. That's a big part of his kind of whole campaign on national defense technology, a big push for the government as well at the same time, while then freeing up the US side as well, because that could open the way for the missiles to be removed from Turkey. That's perhaps one way for them to square the circle on this.
Perhaps a win-win for both sides. We'll wait to see. Bloomberg's Patrick Sykes in Istanbul. Patrick, thanks so much for your reporting. Appreciate it. Coming up, U.S. Trade Representative Jamieson Greer, says he is happy to consider removing South Africa from AGOA. We'll bring you that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. U.S. Trade Representative Jason Greer says he's happy to consider removing South Africa from the list of African nations that receives duty-free access to the American economy. At a Senate Appropriations Subcommittee hearing, Greer called the country a unique case.
They're a real economy. They're a big economy, right? They have an industrial base. They have an agricultural base. They should be buying things from the United States.
But if you extend AGOA for 1 year without reforming it, that's going to benefit South Africa, right?
It could. I would say we have a 30% reciprocal tariff on South Africa right now, which is much higher than the rest of the continent. So we'll control for it a little bit. But I think South Africa is a unique case. I agree with you, if that's your point.
Don't you think we ought to separate South Africa and AGOA?
I'm happy to consider that.
Let's stay on the continent. The Rwanda-backed M23 rebel group claimed it captured the strategic city of Uvira in the Eastern Democratic Republic of Congo less than a week after a peace deal was signed in Washington. The rebels now control the three biggest cities in the region, showing no sign of pulling back. And Ghana's economy expanded at a slower pace in the third quarter as the contribution from the services and industrial sectors cooled. Gross domestic product grew by 5.5% in the 3 months through September. The government has vowed to maintain fiscal discipline as it prepares to exit a funding program with the IMF and projects growth of 4.8% in 2026 compared with 4% this year. Let's go to tech now. The chief executive of chip equipment maker ASML believes the huge investments being made in AI infrastructure are justified. ASML is Europe's most valuable company and a crucial pillar of the global AI supply chain. Its gear underpins major AI breakthroughs from NVIDIA's cutting-edge semiconductors to ChatGPT. Speaking last month, Christophe Fouquet told Bloomberg Tech Europe there is logic behind the massive spending by the likes of OpenAI.
I think the investment makes sense overall, because you cannot play in AI without investing in hyperscaler. And there may be even a few cycles of investment, because the investment today is done on certain chips. The chips in 2-3 years from now, if you look at NVIDIA announcement, they will be a lot more powerful. And people may be tempted again in 2027 to invest again in hyperscaler to make use of those chips. So you have different cycles, and you have a bit of a arms race, because if you don't invest today, you're out.
And you can watch more of that exclusive interview with the ASML CEO tomorrow on the next episode of Bloomberg Tech Europe. We'll also get his views on AI bubble fears, Western tech restrictions on China, and Europe's chances in the AI race. That's at 6:30 UK time on Bloomberg TV. You can also watch on the terminal, Bloomberg.com, and on YouTube. Now let's just take a quick look at where markets are right now. As we mentioned, some of the exuberance from that initial pop that we saw from the Fed cut for equities turning sour after we did get some disappointing results from Oracle, dragging down the likes of also SoftBank and global equities that we're seeing here. Downside for U.S. equities, Euro Stock 50 futures, though, look a bit unchanged right now, though pointing to the downside. That is it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.